Good afternoon, everybody. Welcome to Columbia. Welcome to the School of International and Public Affairs. For those of you who don't know who I am, my name is Trish Mosser. I am the director of the MPA Program in Economic Policy Management and the Initiative on Central Banking and Financial Policy. We have a real treat this afternoon, the opportunity to hear from one of the most respected and experienced central bankers on the planet, and just a week after he has stepped down from office. We're absolutely delighted that Governor Kuroda is visiting Columbia this entire week, and he's kicking off his visit with this talk. The topic of his remarks is going to be the international monetary system, something that he knows just a little bit about. Haruhiko Kuroda was the governor of the Bank of Japan from March of 2013 until literally 10 days ago. For the 8 years before he became governor, he served as the president of the Asian Development Bank. He also had a long and very distinguished career at Japan's Ministry of Finance, ultimately serving as the Vice Minister for International Affairs. In short, he's no stranger at all to the inner workings and to the shortcomings of the international monetary system. So I'm personally very much looking forward to his remarks, and I hope he's going to provide a few suggestions how we might do better as well. I'm equally delighted that Governor Kuroda is also going to have a conversation with Princeton professor Alan Blinder. Alan is the Gordon S. Rentschler Professor of Economics at Princeton, and as I am sure everybody in this room knows, an expert and a scholar on monetary economics and macroeconomics. His writing on macroeconomic policy is positively voluminous and spans a wide range of outlets, academic papers to books to newspaper columns and kind of anything in between. He was the vice chair of the Board of Governors of the Federal Reserve from 1994 to 1996 and served on the White House Council of Economic Advisors. Last but not least, the conversation between Governor Kuroda and Professor Blinder is going to be moderated by my colleague, Takatoshi Ito, well known to most of the people in this room, Professor of International and Public Affairs here at Columbia, and former professor and dean of the Public Policy School at the University of Tokyo. Governor Kuroda, the floor is all yours.
Thank you very much for your kind words. I'm really delighted to be able to talk at Columbia University because I used to visit this university so many times. And so that as a former governor of the Bank of Japan, I'm very happy to talk about the future of the international monetary system. As you know, the international monetary system has changed almost every 30 to 40 years since 19th century. The international gold standard, or the gold pound standard in 1873 to 1914, the lack of an international monetary system from World War I to World War II in 1914 to 46, and the Bretton Woods system, or the gold dollar standard in 1946 to 71, and the general float and the dollar standard from 1971 until now. So, what will the future of the international monetary system look like in the coming decades? The international gold standard was in reality gold pound sterling standard. The British Empire introduced the gold standard in 1816, but most countries continued the silver standard. the California gold rush starting in 1849 and the Australian gold rush starting in 1852 lowered the gold-silver ratio. Then, in 1873, the German Empire adopted the gold standard, utilizing the gold indemnity demanded from France, while the Latin Monetary Union suspended the unlimited minting of silver coins, and the United States ended the coining of silver bullion, followed by Nordic countries, the Ottoman Empire, the Austro-Hungarian Empire, and even Japan. Thus, the international gold standard was established. The international gold standard or gold exchange standard was in reality a gold pound standard successfully managed by the Bank of England. Not all countries follow the rule of game, sometimes sterilizing gold inflow. However, the Bank of England faithfully adjusted the bank rate according to gold flows in and out of the British pound, thereby managing the gold pound standard with paper-thin gold reserves. That was possible because Britain maintained a huge current account surplus, which became more than 10% of GDP before World War I, while exporting capital to the world. Britain was the largest economy and supported free trade, while the Bank of England acted as the world's central bank. The British economy grew on average by slightly below 2%, while the wholesale price index declined by about 2% during the era. When World War I erupted in 1914, the British Empire ended the gold standard, and Germany and other European countries also ended it, followed by Japan in 1917. After the World War I, Britain temporarily returned to the gold standard in 2025, followed by Germany and other European countries. But the Great Depression in 1929 to 39 made all efforts to restore the international gold standard impossible. And the US smooth hold a tariff in 1930, and the British imperial preference in 1931 proliferated trade protectionism worldwide. While exchange rate fluctuated, the gold non-convertible pound as well as gold convertible dollar continued to circulate, but even the United States left the gold standard in 1933. There was no consistent international monetary system. Then the World War II erupted in 1939 with Germany, Italy, and Japan versus France, Great Britain, Soviet Union, the United States, and China on the other side. And it continued until 1945 with a complete lack of an international monetary system. As you know, in 1944, 44 allied nations held the Bretton Woods Conference in the United States and agreed to establish the IMF and the World Bank. The core of the IMF was the Bretton Woods system, which had been agreed upon well before the conference between the US and the UK, while the US representative Harry Dexter White and the UK representative John Maynard Keynes had agreed to the resurrection of the fixed exchange rate system in view of the competitive devaluation during the interwar period. Keynes initially argued for the creation of a central clearing union based on a common currency, banco. But while White insisted on the establishment of an international monetary fund based on the gold dollar standard. As you may recall, under the Bretton Woods system, all IMF member countries had to establish their par values in terms of a gold convertible currency, i.e. the US dollar, and maintain their market exchange rate within the par value plus minus 1%. The United States must, of course, maintain gold convertibility at the official gold price of 1 ounce per $35. So, the Bretton Woods system was a gold dollar system or gold dollar standard, somewhat similar to the gold pound standard before the World War I. At the same time, all its members had to liberalize current account transactions while capital control may be allowed. And the IMF would provide financial support to members in case of need. The Bretton Woods system functioned quite well for nearly a quarter century, mainly because the United States held a huge amount of gold, something like 65% of world gold reserves after the Second World War, maintained a strong international position and continued to be by far the biggest economy in the world. The growth rates of OECD countries in the 1950s averaged 4%, and in the 1960s, they averaged 5%, far better than the interwar period. Favorable conditions for the Bretton Woods system started to disappear in the late 1960s, since first, US current account surplus rapidly shrank, partly due to the Vietnam War and Great Society expenditure. Second, dollar holdings by Europe and Japan soared substantially. And third, US policies to reduce capital outflows did not work. Then, the so-called gold pool to maintain gold market prices from going beyond its official price was dissolved in 1968, further encouraging countries to request the US dollar conversion to gold. Already in early 1960s, Robert Triffin argued the famous Triffin's dilemma. That is, the US must continue to have a balance of payment deficit in order to keep the system liquid and fuel economic growth, but US deficit would inevitably erode confidence on the gold convertibility of the dollar. However, this Triffin's dilemma is falsified by the gold pound standard successfully managed by the British Empire in the 19th century through maintained confidence in the gold convertibility of the pound with a huge current account surplus while exporting equally huge amount of capital to the world. Anyway, on August 15, 1971, the United States abandoned the gold convertibility of the dollar, so the Bretton Woods system collapsed and has never been restored. This is known as the Nixon shock in Japan. General float of many or major currencies has continued until now without gold convertibility of the dollar. But interestingly, even without gold convertibility, the US dollar has continued to be the international currency. The United States is still the largest economy and has the strongest financial sector in the world. As Charles Kindleberger famously argued, an international monetary system with one international currency, the dollar, is the most efficient. Like one international language, English, is the most efficient way of international communication. The world economy has continued to grow by 3 to 4% in 1971 to 2022, despite periodic downturns due to oil and financial crises. So the current dollar standard has, with general float, appears to be very robust, continued more than 50 years. And the share of the dollar in international reserves stayed around 6%, with the euro at around 20% and renminbi at only about 2%. While the share of the dollar in foreign exchange transactions is at 44%, with the euro at 16%, and again, renminbi at 2%. So the current international monetary system is likely to continue for some time. However, we might see three possible evolutions of international monetary system in the future as follows. The first possibility is a fragmentation of the international monetary system. The world economy has already become somewhat fragmented since China strengthened its military presence in the South China Sea and Russia invaded Ukraine. Recent G20 meetings regarding international economic issues showed a division of the 20 members into three groups. Group A consisting of China, Russia, and Saudi Arabia, interestingly. Group B consisting of G7, the European Union, and Australia. And Group C consisting of other countries like Mexico, Argentina, Brazil, Korea, Indonesia, India, Turkey, and South Africa, what we call Global South. Group B countries are imposing strict economic sanctions on Russia, including expulsion from SWIFT and strict regulations over IT goods and technology export to China. Group B countries intend to promote friendshoring instead of indiscriminate offshoring to Group A countries, while the US, the European Union, and Japan intend to restart onshoring of semiconductors and high-tech production. China has started using renminbi for oil imports from Russia and Saudi Arabia and is spreading RMB transactions to Asia and Africa. Group A countries are exiting from Group B currencies, in particular the US dollar. The use of the euro in Eastern Europe and North Africa is increasing. If fragmentation of the world economy continues, the international monetary system might also become fragmented. With fragmentation of the international monetary system, trade restrictions, and exchange instability, the situation may look increasingly similar to the situation between World War I and World War II. Second possibility is a multiple currency system with CBDCs, central bank digital currencies. By the 2030s, many important economies may introduce CBDCs, which might be freely used for cross-border transactions. Then, currencies like the dollar, euro, pound, yen, and even renminbi, and so on, might be easily sent and exchanged without much cost and time, making them all international currencies. This will likely reduce exchange risks for countries with multiple international currency holdings, and as advanced AI technologies make translation easy and costless, reducing the need for one single international language, English, CBDC advanced technologies may make international transactions easy and costless, reducing the need for one single international currency, the dollar, resulting in the negation of Kindleberger's dictum. Of course, it may be argued that such a multiple currency system might be inherently unstable, as Gresham's law predicts. However, the gold pound standard was successfully managed by the Bank of England for more than 40 years until World War I, although the gold dollar standard lasted only 25 years. Above all, as Milton Friedman clarified, Gresham's law is valid only when the exchange rates between currencies are fixed, which is not the case now. The third or final possibility is an SDR-centered international monetary system. The SDR was created by the IMF charter change in 1969 to complement the dollar as an international reserve asset. But after 1971, not much has been allocated. Then, suddenly in 2022, SDR 456 billion was allocated, equivalent to about $650 billion, which is more than double the total SDRs allocated so far. At the same time, developed countries have agreed to channel allocated SDR to PRGT, RST, and other IMF facilities, and they may also supply SDR to designated holders like multilateral development banks, including the World Bank. In this way, the IMF and the MDBs may, through the lending of SDR to developing countries, realize seigniorage from SDR allocations. SDR has already been an accounting unit for many international organizations, including the United Nations and its agencies, MDBs, and also BIS. SDRs are now available as asset, not only to IMF members, but also to the IMF itself and MDBs. So, the SDR has become a unit of account, means of payment, and value storage for many international institutions. Of course, at this moment, the IMF says the SDR is not a currency, but it is very close to a currency. If SDR designated holders include commercial banks, it will become a currency. Therefore, if IMF members agree to make the SDR a currency and put it at the center of the international monetary system with flexible SDR allocations, we may have an SDR-centered international monetary system with floating exchange rates. Although this is unlikely to be realized in the near future, it might also make the IMF a clearing union based on SDR, as dreamed by John Maynard Keynes. So I just mentioned three possibilities, but as I said before, the current system is quite robust, and the data standard may continue in the next decades or so. But we have to consider the three possibilities in the future. Thank you.
Thank you very much, Governor Kuroda. And we start dialogue between Governor Kuroda and Professor Blinder. And my name is Takatoshi Ito. As Trish introduced me, I'm professor at SIPA here. Okay, so let me start dialogue with from remarks from Professor Blinder. Alan, you want to give us your reactions to Governor Kuroda's speech?
It's working. I will, sort of. Thank you for the speech very much. You're definitely looking beyond the next year or two. That's very clear. And central bankers are a small class of government officials that do look beyond the year or two. So that's always good to hear. I wanted to take up a little bit your fragmentation scenario, the first of your three scenarios, and in particular, the potential role of the RMB as a reserve currency, which has been much discussed, is being much discussed these days, and ask you Let me ask the question the following way, but the real interest is in the RMB. Years ago, when you were in the MAF in Japan, there was a lot of discussion of the yen becoming an international reserve currency. I see there are some young people in the room that don't remember this, but the yen was Japan was the superstar economy in the 80s, not China. It was kind of in the role that China is now. Like it was always Japan, 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 just as everything today is China, China, China. Japan, I understand from you, had some internal debate over whether this was a good idea or a bad idea. And I wonder if you could tell us a little bit about that and then relate it to what you think about the idea of China taking a non-trivial role in, as a reserve currency.
Yeah, as you said, in 1980s, the Japanese government tried to make the yen an international currency to complement the US dollar. Now, in order to do so, of course, the Japanese government completely liberalized foreign exchange transactions. Capital control was abolished, and any foreign transactions became completely free. And on top of that, the government made JGB holders, foreign JGB holders, exempt from income tax on interest. By so doing, the government hoped JGBs could be a good asset to be held by foreign investors and companies, and so on and so forth. So the government tried to make the Japanese yen an international currency, but then, as you know, the asset bubble burst in the 1990s, and the Japanese economy also suffered significantly, and so that the idea of making the Japanese yen an international currency has almost stopped. Although, of course, the Japanese yen as a part of the international reserves held by many countries, I can't remember the figure, but probably 7-8% bigger than the RMB. And also foreign exchange transactions bigger than RMB. Now, China apparently intend to make the renminbi a international currency. But there appears to be some hurdles for them to make the RMB an international currency. First, they still maintain capital control, foreign exchange control. Under capital control, of course, transaction with RMB is not free, not liberalized, so that RMB cannot become an international currency with capital control. And when and how the Chinese government decide to abolish capital control, I don't know. And also, of course, they maintain income tax on interest rate, whether or not the holders are domestic Chinese or foreigners. So I don't think at this stage it's unlikely that the renminbi become an international currency. But already the Chinese economy is the second largest economy. The development of the Chinese economy is really amazing. When China joined the WTO in 2001, the scale of the Chinese economy was only about 30% of the Japanese economy. But now, Chinese economy is 3 times bigger than the Japanese economy. So in the last 20 years or so, the amazing growth of the Chinese economy made it the second largest economy and still growing faster than OECD countries, 4-5% still. OECD countries' growth rate, including, by the way, US or Japan, only 1-2%. So this will make the Chinese economy the biggest economy in the world within a couple of decades. And by that time, China may abolish capital control, and then RMB might become second largest international
So when
currency.
did you say abolish? Did you give a year to that?
No.
I-
By the way, my good friend Martin Wolf of the Financial Times, he told me that several years ago, he told me that China may continue exchange control, capital control next 3 decades. Well, I don't know why he said 3 decades, but
I think he meant a long time, right? That's right. To pursue that just for a moment, China, as you properly say, in trade, is a giant. It's the
Yeah.
elephant
Yeah.
in the room.
Yeah.
In finance, it's still a midget, basically, in
Yeah.
the world
Yeah.
financial markets.
Yeah.
And that's why I broached this question to you. It seems you have to be willing, as a nation, to do a whole lot of things in the financial realm. You mentioned, you didn't use the word floating, you meant liberalized foreign exchange. You mentioned capital controls and a couple of other things. And maybe Martin Wolf is thinking it's going to be 30 years before China. I remember saying in a public forum 50 years, but I'm not. 50 years plus or minus 25. These things have very large standard errors to them. But it doesn't, I don't want to speak for you, it doesn't sound like you disagree with that very much. Is that right?
on the whole, yes, because Chinese economy will continue to grow, but the financial system is still very much regulated, and also the capital control still exists in a very extensive manner. Probably the Chinese government thinks that for the time being, it is necessary for protecting the Chinese economy, so that the priority is protecting the Chinese economy from international financial impact, effect, and so on and so forth. And renminbi internationalization may be the second order priority at this stage, but the priority may change.
Sticking with that theme a little bit, but on a different angle. Both when I was on the Federal Reserve a million years ago and in my current life, speaking to audiences of all sorts, I get asked a lot, and I'm sure you've been asked about similar things vis-a-vis Japan, whether the Federal Reserve in its monetary policy, I don't want you to comment on the Fed, you're commenting on the Bank of Japan, ought to take account of what its actions do to other countries. And I'm sure the same sort of question is raised about the BOJ and other major central banks. Would you say something, and we'll say something about that, and the reason it's a segue is, does that have anything to do with being a reserve currency?
I think, I mean, as the governor of the Bank of Japan, I had been involved in many Asian discussions, meetings, ASEAN +3 meetings,
Japan, Korea, China meeting, and also APEC, ASEM meetings, and so on and so forth. There, of course, we discussed about the impact of Japanese monetary policy on those regional economies and finance and so on and so forth. But certainly, most of them were more concerned about the Federal Reserve impact on their finance and economy rather than Japanese or European. And that is quite reasonable because Asia is still dollar-dominated region. International transactions done in the US dollar rather than various domestic currencies. Of course, China now is trying to expand renminbi transactions with many countries in Asia as well as in the Middle East. But still, Asia is a dollar-dominated region. And so always Asian countries, like Latin American countries, are very much concerned about how Federal Reserve makes monetary policy which might affect their currencies, their finance, and even their economies.
So do you think the Fed should care about what happens in Brazil?
I can't say anything for the Federal Reserve.
Okay,
but,
I withdraw.
But I understand, for instance, former Federal Reserve Chair Janet Yellen argued that certainly when Federal Reserve decide monetary policy, it would consider possible impact on particularly emerging economies and so on and so forth. But of course, Federal Reserve monetary policy is targeted at the U.S. economy, and consideration of the U.S. economy and the finance is the basis of Federal Reserve policy, not the impact on emerging economy. But she said that the Federal Reserve consider the possible impact on those economies.
So, in a sense, euro was created to have the region of economies independent from dollar fluctuations. So it's natural that some other countries like China and neighbors want to create a block of economies which could be independent from those Federal Reserve hiking or lowering the interest rate. Would that be a good reason to have the third polar of an international currency?
I think the idea of creating the euro followed the establishment of the European Union. And the establishment of the European Union first argued for by many European politicians. First concern was for the last 3 centuries, Europe was always under some war, regional and global war. And the European political leaders after the Second World War decided never to have war in Europe, so that they try to integrate their economies. And the final result was, of course, European. Initially, EEC or EC, and now EU, with comprehensive domestic as well as foreign policy. And the euro was created in 1999 to make the European Union quite well regionally integrated economy. And I don't think they created the euro in order to make the European economy less dependent or less affected by the US economy or US monetary policy. I don't think so. But anyway, the euro has become a big currency union, and now it covers 20 countries. And the European Central Bank is a central bank for 20 economies. So now it's bigger than the US, and in that sense, the European Central Bank is bigger than the FRB.
So, Alan, does U.S. welcome or is concerned of the emergence of euro or renminbi bloc, or what is the view in Washington?
Well, a feeling in Washington, of course, the euro exists, and nobody is going to be trying to get rid of the euro in any sense. But I do remember, apropos of what Kuroda-san was just saying, that during the 90s, between Maastricht and the start of the euro, a lot of us American economists were saying to the Europeans, you are not an optimal currency area. This is not a great idea. But the answer was exactly what Kuroda-san just said, that Mitterrand and Kohl said, this is about making sure Germany and France don't go to war again. And, you know, that's probably a much bigger deal than some Harburger triangles of inefficiency involved in having a suboptimal currency area. And, you know, to me, that swamps all the other considerations, as it did for the Europeans. Do you have a few minutes for Japanese monetary policy? So I want to ask you about this. Until about 2 years ago, and lasting for a dozen years before that, the central banks in the world, including yours, so this is your entire tenure almost as the head of the BOJ, were trying to get inflation to go up. So it started in Japan, but it didn't. What's that? You know that TV commercial? What stays? What starts in Japan doesn't stay in Japan? No. But it was the job of the ECB, it was the job of the Fed and many other central banks around the world. Since you had in your seat more experience with this problem than anybody else, why do you think it was so hard to push the exchange rate up?
I first of all, I think the Japanese experience is somewhat unique among OECD countries. First, we had a huge financial crisis in 1990s, and then from 1998 through 2012, as I said, we had persistent deflation. Average deflation rate was only minus 0.3%, but among 15 years, 11 years, price declined. So mild but very persistent deflation. And during this 15-year-long deflationary period, economy stagnated and employment stagnated, and growth rate had been suboptimal. So when I became governor of the Bank of Japan, I tried to eradicate this deflationary situation. by introducing substantial monetary easing, expansionary monetary policy. And then in the last 10 years or so, the economy was reinvigorated, and employment increased substantially. For instance, 4 million new jobs have been created. Unemployment rate used to be 4 to 5%, is now only about 2.5%. And also inflation, deflation has been overcome, and the inflation rate remained only about 1%, never reaching the 2% inflation target. So in that sense, the very expansionary monetary policy has succeeded in reinvigorating the economy and increasing employment and so on and so forth, but could not achieve 2% inflation target in a sustainable manner. The main reason is, I think, because of 15-year-long deflation, kind of mindset, no price increase, no wage increase, kind of mindset has been very strong, and fairly significant economic improvement has been made, but wages continue to be somewhat stagnant. And but this time appears to be different. Things have changed in two ways. One, of course, because of import price induced inflation reached 4.2% this January. We expect import price inflation is declining, so that CPI inflation would decline toward less than 2% by the middle of fiscal 2023. But thereafter, the inflation rate would rebound. Why? Because this year, wage increase is likely to be more than 3%, highest in the last 30 years. And this is likely to continue next year. Why? The second factor is that, as I said, during the 10-year period, 4 million jobs are created. That means that 4 million labor supply created or increased, mainly women. And the current female labor participation ratio is more than 70%, higher than in the United States, higher than in Canada or France or Italy, almost comparable to German and British level. So that it is very difficult to further increase female labor participation ratio, so that further increase of labor supply is unlikely, so that wages will rise, will continue to rise. So kind of mindset, no price increase, no wage increase mindset has been changing rapidly. Long-term price inflation expectation is rising. And also the further labor supply is unlikely. So wages would rise, and based on wage increase, about 3% wage increase, 2% inflation could be achieved in a sustainable and stable manner in the near future.
Yeah, so Alan has a new book called Explaining All the History of the U.S. Inflation Rate. So I'd like to ask you to explain what's going on in the current U.S. economy.
With inflation.
Inflation.
Yeah. I think that's actually easy. I think a relatively small, let me backtrack a second. The part of that book, which covers 60 years, that I think is most germane to recent events is the supply shock period of the 70s and 80s. Having said that, let me elaborate a little bit. I think the spike in inflation that we got, and by the way, a spike in inflation in the United States does not mean to 4. We got up on CPI to 11 briefly, I think, something like that, was caused a little bit by excessive demand coming from the fiscal side and the monetary side. Footnote to that, I think there's validity in this criticism of the Fed that they were too slow to turn around and start tightening. But I think by most econometric estimates that I know of, and also by common sense, that's a minor share. If you ask the question, how do we get from 2% inflation to 11% inflation? Nothing we know about the effects of demand, given what it did, would suggest anything remotely close to a 9 percentage point increment in the U.S. inflation rate. So we had supply shocks. We had a big oil shock. Then with the Russia-Ukraine war, we had a food shock on top of it and an exacerbation of the oil shock. Now, blissfully, that part's gone away. The food part has not gone away. Last I looked, food inflation is still very high. And then we had this sui generis, Lord knows, I hope it's sui generis, set of supply disruptions as the world and the United States, as part of the world, came out of the COVID epidemic. Not enough cardboard boxes, not enough shipping containers, not enough trucks, not enough truckers, and it went on and on and on like that. Most of that is behind us. What I think we should have learned from the 70s and 80s, but apparently hasn't been learned in all quarters, is that it's things like that, sharp, rapid supply shocks, that can really move the inflation rate up or down by a lot in a short period of time. Demand tends to move inflation much more slowly. And I'm not sure people have internalized that lesson now. So similarly, if you ask, how did we get inflation down so quickly from 11 to 5? It had to do with the supply shocks. I made an estimate in the Wall Street Journal some months ago that I thought Jay Powell's job, I was making the point it was a lot smaller than Paul Volcker's job, that Jay Powell's job was to knock 2.5% off the inflation rate, which is probably what the excess demand had added to it, and the rest had to come from the supply shock. I still believe that. I think that's a proper diagnosis, roughly speaking, of how we got such high inflation and how it's come down, to the extent it's come down. Now, we're not at 2 yet, obviously.
So I interpreted Kuroda-san's explanation of the last 10 years it was awfully hard to break this zero inflation, zero wage, zero inflation expectation, this kind of equilibrium. And somehow, for probably wrong reason, but it was broken by the supply side shock. And now the inflation rate is well, at least above 2%. And the wage rate is now increasing. So this 0-0 equilibrium is broken, clearly. And maybe moving up to 2-2 equilibrium or 2-3 equilibrium. And to do that, you have to replace the supply shock by demand shock or excess demand and soft land from below. unlike U.S. soft land from above, but in Japan you have soft land from below to this 2% equilibrium, and you seem to be optimistic that this may happen, so that your 10-year fight against the deflation will come to the happy ending next year. Is my interpretation correct?
Yes. As I said, this time is different. Two factors. One, of course, the negative cycle of no price increase, no wage increase, no inflation expectation increase, and so on and so forth. This negative loop is broken. And during the so-called spring offensive this year, companies and trade unions, labor unions have been discussing how to raise wages in order to compensate the price inflation so far. So that, as I said, this year, wage increase appear to be 3% plus or something like that. That is one point. Another point is, as I said, during the last 10-year period of monetary easing, as I said, 4 million new labor supply has been provided mainly through higher female labor participation. And that made economic recovery and economic growth viable, but at the same time, in some sense, made wage increase less severe because of new labor supply, 4 million, more than 4 million. But now there appears to be no large labor supply increase anymore, so that about 1% plus growth, which is higher than potential growth rate, continues. Simply, tight labor market will make wages to increase. So that two factors. One is negative loop may have been changed, and second, further labor supply increase is unlikely, so that wages would continue to rise and inflation rate could be around 2% in a sustainable and stable manner. I may appear to be quite optimistic.
Thank
but
you.
After 10 years.
So happy ending is coming. Happy exit will be coming. Thank you. So in 10 to 15 minutes, we move to the Q&A from the floor. So prepare for your questions. But I want to briefly go back to this international monetary system and on two topics that there is a lot of talk about weaponization of the dollar, and that is eroding the dominance of the dollar. So U.S. is shooting its own foot, and I'd like to get your reactions to this argument. Second, the SDR. This is very idealistic idea of having the global currency, and I'd like to hear the Alan's reaction, how the Washington is thinking about expanded role of SDR. So first, the weaponization of dollar. Is this a serious
question?
Yeah, sure.
You're only asking me because I'm such a good friend of Janet Yellen's, I think. I think there's some truth to that. The need was great. We needed weapons against Russia. We are not going to use nukes. That would have been a lot worse. We were not going to use military force unless they use military force first to cross the NATO border. We don't trade with them very much. I mean, who does trade with them very much? So trade sanctions against Russia were not going to be much of a weapon for the United States. But there is the monetary system. There is SWIFT and the international banking system. And that's what the U.S. government, the Treasury, turned to. There is a point to the idea that if you go to the well too many times, the well's going to go dry, that you're not going to be able to maintain your status as the world's dominant reserve currency. I'm not imagining this is going to be a repeated game, that this is going to happen again and again and again. I think the Russian situation is largely sui generis. For example, there is incipient conflict on a number of fronts between China and the U.S., but I don't see that going in that direction at all. That seems extremely far.
I think that
far-flung.
2 points. That one is that now Russia is pushed into the renminbi block in the sense that they have to do the international trade in renminbi and settle with the ships instead of SWIFT. And so you're moving. Russia is now moving to use the renminbi in unit of account and settlement and store of value.
Well, I can't speak for the U.S. government on that, but my attitude would be let them try.
Okay. And also some other countries are thinking, oh, if we get displeasure of the Washington, then they'll freeze our central bank assets.
No, that's why I say you don't want to overdo this. But there is a danger of overdoing it, and I think the Treasury is well aware of this. I saw Janet Yellen get this question on TV, or a question very much like that, and she was very much emphasizing this is not something we're thinking we're going to do again and again and again and again. I can do very briefly on your question on the SDR. I think the U.S. Treasury will go to the wall to block that from happening. And the U.S. Treasury could throw its weight around in the IMF when it wants to. And you'll remember cases where it has wanted to.
So Kuroda-san, this weaponization of dollar is part of your multipolar scenario?
Not really. As Alan said, I don't think U.S. government intend to use this kind of economic sanctions against any countries in the future, or at least do not utilize this kind of weapon again and again. I don't think so. So in that sense, I think the dominant role of the US dollar will continue despite this kind of thing in the short run. Now, about SDR, as I said, SDR was created in 1969 because the US promoted the creation of SDR. At that time, of course, US government thought that the burden of the only international currency for the dollar was too much, and so that some reserve assets should be created in order to reduce the burden of the dollar as the international reserve currency. But then, after the 1997 Nixon shock or abrogation of the gold compatibility, the dollar was free of gold compatibility, since then, the U.S. government was not very friendly to SDR. They thought SDR as a competitive currency against the dollar, so that always the U.S. was quite negative in further allocation of SDRs. But as I said, in 2022, the U.S. Treasury agreed substantial allocation, new allocation of SDRs. So that may show some change in the U.S. Strategy regarding the SDR. And so although I share with you some skepticism about the SDR becoming a international currency or the international monetary system centered around the SDR, I mean, it's unlikely, at least in the near future, but still SDRs are created by the United States, and the latest substantial allocation of SDR was accepted by the United States. That means that that in the future, greater role of SDR, U.S. might accept, might agree, but this is my personal hope.
Thank you very much. And we move to a Q&A. Wait. So there's one condition that Governor Kuroda will not answer the questions about current Bank of Japan policy. What Bank of Japan will do next week, for example. Those are questions he cannot answer. But past policies will be okay. So with that conditions, any questions? Yes. Paul? Yeah, it's coming.
Thank you very much. Paul Sheard. It's a very innocuous question. I wanted to ask a question about central banks' internal expertise and capacity and maybe decision-making process. We've just seen in the last year or two a huge forecasting error by central banks all around the world. And as Professor Blinder pointed out, certainly I would see a big picture. The reason for that forecasting error was that once we got through COVID, it turned out that there was much more damage done to the supply side of the economy. Supply was constricted, whereas with all the stimulus, the demand came back quite strongly and we got the inflation shock. My question is, central banks' research departments and policy departments tend to be full of macroeconomists who are very much focused on the demand side of the economy. Do you think that central banks need to look at having more microeconomists who are much more attuned to what is going on the supply side of the economy so that the supply and demand components of those scissors can be grasped and reflected better in monetary policy decision-making?
No, wait.
I bunched three questions together.
Okay,
And
you first.
Thank you.
And I'll chime in.
Yeah.
My question is more of a geopolitical. Since you said about 3 divisions in the future, I have particular questions about India and South Korea, because India and South Korea and Japan just joined the IPEF, which is the Indo-Pacific Economic Forum with the United States framework. And Japan and South Korea are collaborating in diplomacy. You know, it seems that they are moving against China in some ways with your new national security policy. So what do you think about India and South Korea in the future? Thank you.
third question, Murasa-san.
Satoru Murasi. I had a question just basically on the international financial system. What do you see in the next 2-3 years as the biggest threat? Nobody can predict these crises, et cetera, but is there something from each of you, actually, that concerns you from that perspective, the relatively near future, 2-3 years.
Okay, 3 questions.
Yeah. Certainly, most central banks, including the Bank of Japan, have many macroeconomists within their research department. But at the same time, for instance, Bank of Japan periodically makes industry-wise or region-wise economic surveys, and also various microeconomic analyses we make and publish those results. The reason why many central banks fail to predict the impact on the economy of the pandemic and the aftermath of the pandemic, I think it's in some sense understandable, because it's quite unique. This huge pandemic is the first since the Spanish flu, more than 100 years ago. And its impact on the society and the economy was really difficult to understand instantly. So I think in some sense it was inevitable, and I don't think only central banks be criticized. Private economists, international organizations, as well as governments, fail to fully understand the impact of the pandemic and the aftermath of the pandemic. The geopolitical situation in Asia is certainly becoming more and more relevant for economic management. You mentioned the South Korea and Japan's relationship with China. For South Korea and for Japan, China is by far the largest trading partner. But at the same time, Japan and South Korea agree to some strategy against technology and high-tech loss to China and so on and so forth, and so that they have strengthened the regulation over technology and high-tech export to China. It is, I think, understandable, and I don't think it would become a comprehensive kind of economic sanctions or economic restrictions. With India, of course, Japan and South Korea have good diplomatic relations, as well as increasingly important economic relations. Now, in the next 2 to 3 years, what is the biggest uncertainty or problems, challenges faced by the world economy, as well as central banks in the world? I think, of course, inflation is a big issue, but as Alan said, US as well as Europe are likely to contain inflation in the next couple of years without creating recession in their economies. So I don't think that is a major challenge or problem faced by the world economy. More, I'm concerned about the war in Ukraine and the fragmentation of the world economy. And this is really a serious problem. It's not a matter to be solved by central banks, but the government and political leaders. But this is really quite serious issue. Of course, climate change risk is big, and it would be a major risk problem in the next 20, 30 years. But in the next 2 to 3 years time, I think current fragmentation of the world economy is one of the most concerned about.
Alan?
Yeah, I largely agree with that. Let me just make a few brief remarks. First of all, your point about central bank staffs being sort of overloaded with macroeconomists compared to microeconomists has some validity, but there's a reason for it because that's what they're about. And the main thing I wanted to say about that is, so first of all, they do have microeconomists that study labor markets and energy markets and a bunch of other things. Where I come from in the academy, which influences, that's where the central bank staffs get trained. Microeconomics is all about equilibrium states. This was about disequilibrium states. The microeconomists are not so good about that. Neither are we macroeconomists, but they're not so good about that. The big surprise to me, as a former member of Team Transitory, was how long it took capitalism to patch this up. That was about the disequilibrium lasting a lot longer than I imagined. I and many other people imagined it would. The biggest threat, you know, the only honest answer to what's the biggest threat in the next couple of years is nobody knows. Let me just take a couple of stabs at that. One is a hardy perennial, which comes up sort of constantly, which is disruptive capital flows in and out of developing countries. It doesn't look like this is imminent right now, like today's problem, but if we go 5, 6 years without that being a problem, that would be a near miracle because it just keeps on happening. Second thing I worry about is Russia becoming a, what's the right way to put this? I don't want to say permanent, but a quasi-permanent renegade state and making other kinds of troubles. It's made terrible trouble in Ukraine. As long as Putin sits in the throne, I'm not optimistic about the future of Russia behaving itself. And then there is, and again, I don't know. I don't see this happening in a 2 to 3 year framework, but I could be dead wrong. China and the U.S. are not on a good path in geopolitics, in economics, in a whole variety of places. Maybe it'll all get better. I hope it gets better. But those are the 2 800-pound gorillas in the world economy. And if they start throwing stones at each other, a lot of smaller gorillas are going to get it on the head. So hopefully that's not going to happen.
Okay, thank you. Way back.
Thank you so much for coming today. My name is Furukawa. I'm currently studying at Columbia University, and I'm Japanese. So my question is about historic and yen depreciation. So although the Abenomics actually helped for Japanese exporting companies as the strong yen shifted to weak yen, but there are so many adverse effects because of the current weak yen. I'm also one of the Japanese students who study in the U.S. And then my tuition went higher for 9 million yen, which is $60,000 because I joined this year. And I'm wondering, how do you think about the side effects of this drastic policy? Because I heard there are some foreign exchange gains, and I was even hoping those some marginal gains would be returned to Japanese students who suffered by this weak yen. So thank you so much.
Second question? Yeah.
My name is Dwayne Rice Mason. My question regards the central role of the dollar in the international financial system. Saudi Arabia at Davos said that they are now willing to accept payment for oil in a currency other than the dollar. How important is the dollar-oil link, and if it is truly cut, I mean, is there some geopolitical change in the world happening?
Third question from here.
Abdullah Ustansel, Zicklin School of Business, Baruch College. Governor Kuroda, I have this question. You mentioned the second alternative of central bank digital currencies. Actually, all the currencies have already been digitized, and there is an infrastructure for that. So on top of that, in addition to that, building central bank digital currencies, as you have described, has advantages of faster transaction processing and cheaper transaction processing. That's mainly a ledger process. So the current system can definitely be improved. So is there more to that scenario? And would that be a likely scenario? Thank you.
Thank you. Okay.
Maybe.
You definitely take the end question. I'm not touching that.
Yeah. At the Ministry of Finance, as Director General of the International Finance Bureau, as well as Vice Minister of Finance for International Affairs, I was involved in exchange rate issue for something like 7 years. And my experience taught me to make any exchange rate forecast is liable to fail. So it's not easy to forecast exchange rate movement. Of course, after exchange rate moved, you can make some explanation, but it has no predictable value. The only well-established exchange rate theory is PPP, purchasing power parity. It was advanced more than 100 years ago by a Swedish economist, and it is still valid. That is to say, in the next 20 or 30 years' time, country with higher inflation rate would have lower exchange rate. But this is almost tautology, and since inflation rate prediction in the next 20, 30 years is almost as difficult as exchange rate in the next 20, 30 years' time. So PPP is valid. It's the only well-tested and valid exchange rate theory, but it has no predictable or predicting value. And so it has no policy implications, except that if you have higher inflation, your currency would eventually depreciate. And so the yen fluctuated in the last 30 years, appreciated and depreciated and appreciated, depreciated. At this moment, it's about 130 to 35 yen to the dollar. And whether it would remain around here or not, it's impossible to say. So and also, as you know, all central banks, except for small open economy central banks, which are in charge of exchange rate policy, all central banks of major countries like Federal Reserve, ECB, or Bank of Japan are not involved in exchange rate policy. So unfortunately, I cannot say anything about the reason why yen fluctuated and how the yen would fluctuate in the future. Dollar oil nexus is certainly true, and it existed in the last 50 years or so. But now, as you said, Saudi Arabia is trying to exit from the dollar and accepting renminbi or whatever currency. And this is likely to continue because this is not purely economic or financial consideration. It's related to geopolitical issue, and I think Saudi Arabia, as well as some Middle Eastern or other oil producers, may wish to diversify trading currencies, diversifying from the dollar. CBDCs, I think CBDCs are somewhat different from those digital currencies or digital way of sending money done by various IT companies or financial institutions, in the sense that digital central bank digital currency is the final settlement with secured value, and so in that sense, I think central bank digital currency is like banknote, as well as the reserve deposit at the central banks, which are money. And CBDC would replace some of or all of paper banknote, but continue to retain its final way of settlement with assured value. So I think in that sense, CBDC could make significant improvement to the way final settlement is done efficiently, safely, and almost instantly, even cross-border.
Very briefly, going backwards, I share the gentleman's skepticism about the importance of CDBCs. As you correctly said, most of our transactions are digitized already. At Princeton University, if you go in the cafeteria, they don't take money. They'll take my credit card.
Yeah.
That's digital money. And maybe eventually they'll take CDBCs. I don't know. But I had the view, I don't understand why, if there's a central bank digital currency and there's an Elon Musk digital currency and there's a Walmart digital currency, anybody would want those others that don't have the Federal Reserve behind them in the U.S. and similarly in other countries. So I think there's a, quote, danger. Now, you may think this is a good thing or a bad thing, that if the central bank goes into that business, it drives the private sector out of the business. Now, the last quick remark I want to make about that is nothing I just said should be in any way interpreted to denigrate blockchain technology, which is apparently a big advance over what came before in a variety of applications, of which cryptocurrencies is just one. So even if you don't believe in cryptocurrencies very much, which I don't, the blockchain technology is a whole different story. Saudi Arabia taking RMB, you know, I'm not going to elaborate on that. Kuroda-san said it well. This is a geopolitical statement that they're making, and I think the proper attitude of the U.S. government should be, so what?
That's it.
That's it.
Okay, thank you very much. And unfortunately, we have come to the end of allotted time this evening. And first and foremost, I'd like to thank Governor Kuroda and Professor Blinder for their time and insight. And I'd like to also thank Dean Karen Yarimilo for allowing us to host this event at SIPA and her generous financial support. Finally, I'm grateful for support of this event co-sponsors. And first, the Center on Japanese Economy and Business, CJEB, at Columbia Business School, which made possible Governor Kuroda fly to the United States only 10 days after his term. And the also initiative for central banking and financial policy, and the Center on Global Economy and Governance, and MPA in Economic Policy Management, all in SIPA. And we also thank you for all of you joining this evening. On monetary policy, there is another event 2 days from today on Wednesday at the Business School, CJEB standalone event. So if you're interested in Japanese monetary policy, please come back on Wednesday. And I think we want to have this event as first of the regular visit by Mr. Kuroda. And next year, I hope that I'm holding up the Kuroda-san's book on the 10 years of Japanese monetary policy on happy end, with happy end. So with that note, I'd like to close this event. Thank you very much.
Thank you. Thank you. Thank you. Thank you. Thank you. Yeah.